Very good morning. Welcome to Money Wise on 938 Live. Joining us this morning is Dennis Ng. He's an author of Mastering Your Personal Finance. Now, Dennis says an average Singaporean earning $6,000 a month can make $1 million after 15 years. And he wrote this book to tell you how to do just that. So we're going to talk to Dennis this morning and ask him what the motivation was for writing Mastering Your Personal Finance. Good morning, Dennis.
Yeah, good morning, Keith.
Dennis, let's see, what was your motivation for writing this book?
Very simple, because what I noticed is that even though Singapore is the second richest country in Asia after Japan, but the problem is I noticed that by age 55, only about one-third of Singaporeans have more than 67,000 in their CPF accounts, and that really worries me.
So it worries you. It worries me. Instead, $67,000 these days will not even make your minimum sum.
Yes, that's right. So, which really worries me. And I, on the other hand, I look at myself. I earn an average income of $6,000 for the 15 years from 1993 to 2008. But by the end of 2008, I managed to accumulate $1 million, very much enough to retire at age 39 then. So I begin to wonder, there must be a lot of people out there who do not know how to manage their finances like I do.
So is this case, this scenario, particular to Singaporeans? Do we not know how to manage our personal finances?
I think we are quite good, we are quite good at saving. A lot of Singaporeans have savings. What most Singaporeans do not really know how to do is how to grow their money. And in fact, if I only depend on my savings, probably by now I would only have about $250,000 instead of over $1 million. So the reason why I became a millionaire is because I know how to grow my money, my savings from 200,000 to over 1 million by now. That's how I became a millionaire, not because I have high income or because, I have any inheritance.
Okay. So did you have to take major risks, to generate this kind of an income for yourself?
Oh, you see, this is another misconception about risk, I have to say that risk can be reduced by two things. One thing is called knowledge, and the second thing is about experience. So it is risky if you invest without knowing how to invest. But if you know how to invest, then with the knowledge you can reduce your risk. And further, if you have more experience investing, that can also reduce your risk. For instance, in year 2007, while most people actually went in to buy stocks and buy properties at high prices, in year 2007 I was doing exactly the opposite. I was selling my stocks at very high prices. I was selling my property at high prices. And that's the reason why I managed to reach $1 million by year 2008, because I managed to sell most of my investment at a very high price before the global financial crisis.
Okay, history seems to be repeating itself. We've got high property prices now, and, the share market isn't exactly doing great. So, in this kind of a market, what would someone, astute investor do?
An astute investor probably at this moment might be starting to raise his cash position because prices are actually quite high. For instance, some of the stocks I bought in year 2008, they have gone up by over 100 to 200%. So I have to say that, making 200% in less than 2 years is indeed very good. And of course, on the flip side, it also shows that a lot of the stocks, the prices are already quite high. So unless year 2001 turns out to be an even better year than year 2010, otherwise, as the stock prices move higher, the risks have actually increased instead of reduced. But the problem is now I'm seeing more people interested to invest compared to year 2009 when the risk was higher because the prices was generally lower.
Is this perhaps a trend of Singaporeans? We kind of miss the boat, and when things are high, that's when we jump on the bandwagon?
It is not just Singaporeans. This is throughout the whole world. Throughout the whole world, people who do not know how to invest, they will only start to feel comfortable when the economy is doing well, when they are getting pay increment. But they forgot that is precisely the most dangerous part, because most economies go through cycle. So when you are having pay increment, when you are seeing the economy doing very well, in fact, after that will be probably the start of a slowdown in the economy. So most people actually end up buy high, sell low. Whereas, to make money from investing, it's very simple. It's to do the reverse. Buy low, sell high.
Is it that simple, Dennis? Just saying it, buy low, sell high, that is basic economics, but not many people can, catch the wave, so to speak.
No, you don't have to catch the waves, In fact, there are many ways that you can actually learn, how to determine whether prices are low or high. Because some people will say, buy low, sell high. I've heard that many times. But I have to tell you, if Jim Rogers is saying the same thing, if Warren Buffett is saying the same thing, if George Soros is saying the same thing, it just tells you this is the truth. The only truth is that you did not learn how to invest. You did not learn how you can, like Dennis, learn how to value a stock, learn how to value a property, and then you determine when is a low price and when is a high price. Because you don't know, and yet you thought that it can't be done. But sorry, I'm one living person in Singapore who has shown that it can be done. I have done it.
Indeed, he has. Now, that is Dennis Ng. He is the author of Mastering Your Personal Finance. Now, Dennis will be joining us again next week. If you have questions for Dennis, you don't have to wait. All you have to do is email us at fresh@938live.sg, and we'll put it to Dennis when he joins us again on MoneyWise next week. Dennis, thank you so much for joining us this morning.
It's a pleasure. Thank you very much.